This is In Focus, a Creamer Media Insight series focusing on key economic issues. I'm Marianne Webb. We are now on the fourth of 5 episodes on copper. In the previous episodes, we have spoken to experts about supply and demand dynamics. But there's another dimension to the copper story that is playing out in boardrooms across the world. Mining companies are repositioning their portfolios to get ahead of the copper curve. To explore the metals investment case, I'm joined by Helen Amos, Managing Director and Commodities Analyst at leading financial services provider BMO Capital Markets. Helen, thank you for joining us. The copper investment case has strengthened significantly in recent years. What are some of the key drivers behind the growing focus on copper?
Well, firstly, thank you very much for having me today. It's great to talk about a fantastic commodity like copper. Look, from the mining company's perspective, essentially, the reason why they like copper is because they're being rewarded by investors for leaning their portfolios more heavily towards that commodity. So, they're looking at the multiples that are being achieved by some of the pure play copper companies right now. And if they're still diversified at all, if they hold other commodities like iron ore, coal, aluminium, or zinc, they are basically being motivated to shift their portfolio mix so that they look as much like a copper company as possible, because that's where the valuations are, that's where the multiples are. So it's not so much why do mining companies want to focus on copper, but the question is why do investors like copper? And essentially, there is now a very widespread, I'd say kind of mainstream belief now that there is a very compelling story that copper prices will continue to rise in the future. And that's from a structural perspective. Obviously, we've got that volatility from week to week, month to month. And that compelling story is centered around two things. One, that there is rising demand for copper as economic activity globally becomes increasingly electrified. And that shift was well underway, by the way. This has been playing out for a good decade at least. This molecules, fossil fuels to electrons transition, particularly being led by China's deployment of renewables and electric vehicles, actually. But just in the last 2 years, we've got another layer onto that demand story, which is AI, so data centers. And that's something that investors can very easily engage with. And then on the supply side, so the second component of this nice story is that there's a belief that there's a lack of new projects, that it's difficult to develop projects, that they're costly, but also that there's non-economic barriers to entry as well, like community issues, environmental issues, approval process. So nice, simple story. It's been reinforced time and time again by mining companies and some very influential voices in the industry. And I would say for the most part, I'm in complete agreement with that. There are some nuances to the story, which we will come to shortly, but that's essentially why investors and therefore mining companies are very much focused on copper right now.
We're also seeing intensified competition for copper assets, with mining houses pursuing large-scale M&A transactions. Does this reinforce the view that high-quality copper assets are becoming increasingly scarce and therefore more valuable?
I think there's two different parts of that question. So maybe on the first one, that I would say the reason why they're pursuing M&A over, say, purely organic project growth, again, it comes back to what shareholders want. So shareholders don't like owning companies that are encumbered with really risky, capital-intensive project development. And that's largely because of historic lessons where there have been some major capital blowouts, very extended project development time frames. And over those periods of time, shareholders aren't getting their returns. They're not getting their paybacks. But at the same time, shareholders, the investors, they do want copper growth as well. And the quickest, lowest risk way that they can achieve that is by acquiring already producing assets. And also I would say the other reason for M&A is that there is always a notion that M&A leads to synergies. And I'd say that's true to varying extents. It depends on the particular asset combinations, or that M&A leads to opportunities to restructure portfolios along more copper-centric lines. And we've seen some examples of that in the last couple of years. Now, I'm not sure whether the pursuit of M&A specifically tells us that there is project scarcity globally, though, because I would say that's actually not necessarily true. It's just that Western mining companies, they're screening for projects of a certain type in terms of location and scale. We'll come on to that. And those are the types of projects that are kind of scarce. And that is one of the motivations for M&A.
To what extent is the difficulty of bringing online new copper supply contributing to a premium being placed on existing assets? And is that premium already reflected in current valuations?
Well, this is a huge topic of debate. And I would say there's been several potential corporate combinations tabled in the industry in the last couple of years, some very high profile ones with major mining companies that have actually failed. And they've not been successful. And it is perceived by many people in our world that the valuations have been the likely sticking point there. So a mismatch between what the acquiring company is willing to pay and what the company being acquired is expecting. And I would say it's scarcity of those suitable acquisition opportunities that really is what creates the premium. So, as I said, it's not to say that there aren't companies and projects out there that can deliver copper growth. It's just that Western mining companies, the ones that kind of we look at in our world, appear to have pretty strict criteria in terms of the project exposure that they want. And that criteria relates to two things: regions that they're willing to want operational exposure in. So they tend to like less risky jurisdictions, and also the scale of the project. So a lot of these mining companies, they only really want to work with projects above a certain scale. Frankly, those project types that they're looking for, that's not where the current wave of new supply or the future wave of new supply is coming from. The current wave of new supply in copper is actually coming from small scale projects in risky jurisdictions, and projects that are consequently, because Western miners don't tend to want to get involved in those types of projects, they're consequently being backed by non-Western capital, primarily China.
How does the return case for copper compare to other transition metals such as lithium, nickel, and cobalt that have had a difficult few years?
Yeah, so those specific battery metals that you mention have traditionally not been seen through the same attractive lens as copper by the mining companies. Now, maybe some of the structural issues around a couple of those might be changing with specific jurisdictional risk and things like that. But essentially, if you look historically, the EBITDA margins, so the profitability on average across the copper sector, has been, much better through the cycle. So all of those commodities that, lithium, nickel, cobalt have had periods of tightness and nice profits, but through the cycle, it's copper that has tended to drive like steady, very healthy margins, and then increasingly return on capital employed. Now, one thing that has been maybe weighing on return on capital employed as a whole in copper historically is the fact that the mining companies are also having to deploy a lot of capital at the same time just to keep their operations going. So the capex deployment rate is also high. But frankly, from an EBITDA margin perspective, copper today is realizing on average across the industry about 60%. That is much higher than what we see in those other metals, and that's what attracts mining companies towards copper. And there's a few reasons why that is true, right? One is that the copper supply curve, so the cost curve, has got some very nice characteristics. It's very steep. And commodities that have a steep cost curve tend to trade with a much wider EBITDA margin than commodities that have a flat cost curve. And that's because there's a wider difference between the price setting part of the cost curve right at the end and then the average player. The other thing is that when you have a commodity that sees rising capital intensity over time, so that's the dollars that you have to deploy to realize per ton of new growth and supply. Generally speaking, the capital intensity of new projects in copper has been rising over time. And that's because we're seeing quite a fierce rate of grade decline on average across the industry, right? So grade is like a primary determinant of your capital intensity. So as grades decline, your next project that comes along is having to mobilize a lot more capital in processing equipment and technology to be able to achieve the same amount of copper produced. So rising capital intensity is one of the reasons why many investors expect EBITDA margins over time for copper to continue to rise.
Are there still opportunities for investors in the copper market?
Well, I guess it all depends on time frame. So, some investors that we speak to are very short term in their time frame, and they'll be looking at weeks or months windows of time. And I would say between now and June, what we're telling investors, what we've been writing about, is that there is probably on balance more upside in the copper price. And the reason why I said end of June is because at the end of June, we expect an update from the US government on their proposed tariff policy on copper cathode into the US. And there is a growing sense that the US may decide to impose a tariff on refined copper, which is giving trading companies and participants in the physical market an opportunity to bring copper into the US ahead of tariff and profit from that if a tariff comes on future dates. And so that dynamic is playing out right now. That's one of the reasons why the arbitrage between COMEX, copper, and London is rising at the moment. And that's essentially draining supply from other places in the world, and that's supporting global prices. Now, beyond that, there could well be a bit of volatility once we get some announcement from the US. But now, from a structural perspective, like a bit longer term, what we're saying is that we still like copper in terms of like average levels over the next 2 to 3 years. And that's because we've still got this stockpiling dynamic playing out because of tariff uncertainty and the sort of geopolitical competition between China and the US to try and secure copper units, which are vital for the AI revolution. But also because when we look at what's really driving the incremental demand for copper at the moment, it's really power infrastructure capex, which ties to this global race for AI supremacy and sort of data center capex as well. And it looks to us that we're still very much in the steep slope of the S curve of that capex deployment in AI and power. And we've probably got another 2, 3, maybe 4 years of that, which represents like a really strong bid for copper units. It's inelastic demand, we think, and that will, and that's being met by basically, frankly, pretty modest growth in mine supply. So we think good story in the short term, actually. Bit of volatility maybe around the summer, around tariff announcements, but from a 3-year view, we still think copper has a good amount of upside.
So no investment cases without risk. What do you think are the key risks that copper investors and potential copper investors need to be clear-eyed about?
Well, I guess it depends on how they're investing in copper. Most investors tend to invest via equities, but some investors do invest in futures. Now, if you're investing in equities, of course, there's always the company-specific risks to think about. There are copper equity ETFs, which sort of smooth out that company-specific risk. But, for individual companies, of course, like project execution and just operational risk, I would say are the key sources of risk for investors to consider. And that's where investors will want to be considering, the jurisdictional risk. And we have had in the last few years some very high profile examples of where jurisdictional risk has led to unexpected changes in production volumes in some countries. So I would say that, and then I'd say so jurisdictional risk, so that's geopolitical, nationalization, changes in taxes and royalty regimes. But then I would also say the ability of the company themselves to execute on projects. And that really comes to, experience of the management teams, but also who they're partnering with on the engineering side. And I would say one of the big themes that came out of CESCO Week a few weeks ago, that was a big copper conference gathering in Santiago every year, was the fact that over the years, the Western EPCM companies, so the engineering companies, are perhaps losing a little bit of expertise and experience in working on big mining projects, not just copper, but other mining projects, because there haven't really been big projects being developed. There have been a few, but not a huge amount. Now, the Chinese engineering companies have been doing a huge amount internationally. So they have a lot of expertise, particularly dealing in, newer frontier locations. But I think that does present a bit of a question that came up as a big talking point at the conference. Who are the Western mining companies going to partner with when they build out the next wave of projects? And Argentina, that's a very exciting new project jurisdiction opening up in the next few years. Lots of companies are looking to deploy projects there. But the question is who is going to build those projects? So I would say those would be the key risks to think about there.
If you were asked to make the investment case for copper in a single sentence, what would that be?
I'll try and make it in one sentence. It might be a couple. I'd say that copper is right at the center of this geostrategic competition for resources that we're seeing right now, between the world's big superpowers, so China and the US, in their endeavors to win the global AI race. And you can see that in policy documents coming out of the US right now. Everything that we're seeing in terms of the race for critical minerals that we're seeing both from China and the US and other countries is a function of this strategic competition. And copper, by value, is probably one of the single most important raw material inputs into enabling the AI revolution. So that is how I would summarize the investment case for copper.
Helen, thank you very much, and thank you for your time today. The investment case for copper is being made not just in research reports, but in a steady flow of billion-dollar transactions and portfolio decisions. In our final episode in this series, we see that investment case being put into action as Beyers Nel, CEO of Harmony Gold Mining Company, one of South Africa's most established gold producers, tells us why his company has decided to make a decisive move into the global copper market.